Welcome, everyone. Nice to have you all here joining us. I'm glad that we have this evening to speak together to learn about women in retirement planning. I am Kelley Slaught. I am the CEO of California Wealth Advisors. So I wanted to welcome you all here. I have a few clients on this call as well, but this will be geared probably more towards my folks that are new here. So I appreciate you all attending. And if you have any questions, please put them in the chat section there and we will try to get them. I have my assistant Erin watching for those, and hopefully I can get to them by the end or maybe answer along the way. So let's go to my slides here. So tonight we're going to talk about women redefining wealth, surviving market volatility, and maximizing your retirement income. So this webinar is really geared towards pre-retirees or retirees as far as the presentation here tonight. I do have a number of other webinars that I have done, and they are on my website, CaliforniaWealthAdvisors.com. So go there and look at some of those. I have more product-specific webinars I've done there. This tonight will be more educational. I'm probably really not going to talk about products so much other than to maybe bring something, make a point of something. So anyway, welcome. I'm glad you're all here. A design for women tonight. Okay, let's get into this. What every woman needs to know about investing. So investing isn't just a man's game, is it? Unfortunately, a lot of times when I have couples that have been married a very long time, the advisor that they have talks to the man. They don't really talk to the women so much. So tonight I am talking directly to you. So the women a lot of times get left out of the decision making, and the man a lot of times makes the decisions. So that's just traditionally how it's been done. And then unfortunately, men don't live as long as women. So the man passes away and then the woman's left with how to deal with the portfolio. And so I'm here to help with that and to educate a lot of you on how to maneuver some of that if that's the position you've been in, or even if you've been looking at your investments over the last number of years, this will be really good for you too. So not just a man's game investing, that's for sure. A study shows that women earn 12% higher returns than men when it comes to individual investments. I think that's an interesting statistic. Women are better at it. Women take less investment risk than men. I think that's interesting too. So a number of things I want you to think about tonight here before I jump into my slides. Know where your assets are. Do a compilation sheet that covers where all your investments are, because all of us are different with that, with where we have investments over the years, IRAs, real estate, different things like that. So know where your investments are. Do you have downside protection for your portfolio? Really important, especially in markets like we've seen this year, up and down and sideways all over the place. Do you have some downside protection in your portfolio? I'll go over that in depth later. Is your portfolio diversified? Very important. That's probably one of the number one things I work with clients is diversifying their assets. Some clients don't necessarily like to be all in the stock market, which is a lot of times what I see. So are you diversified? And I'm going to go over that later when I talk about strategies. Should you do a Roth conversion? A lot of people ask me that question, so I'm going to cover that tonight as well. Is your income going to last for your life? Again, women live longer than men. We've got to plan for that. We've got to plan for the longevity that we have. Are you prepared if you need long-term care? That's the number one concern I hear from people is long-term care, health insurance. How am I going to not be a burden to my family if I need some kind of health care? Look at life insurance policies that are more than 5 years old. If you have one that's more than 5 years old, likely it does not have long-term care attached to it. To buy a straight long-term care policy today is very expensive. So the way I do it now is I take life insurance policies and they automatically now add long-term care onto them for free. So that's how we get long-term care into your portfolio. Have you done a wealth creation assessment plan? So do you have a plan? I mean, number one for me is diversification and to have a plan. You will hear me say that all night. So make sure you have a wealth creation assessment plan. We're here to help you with that, absolutely. What scares you the most about your portfolio? This is a question I've started asking my clients over the last year or so because it's different for everyone. And have you addressed what scares you about your investment or your investment plan? What concerns do you have? Have you looked at legacy planning? I'm going to talk about trust a little bit tonight, but do you have a trust? Have you planned for that? If you died tomorrow, where would your assets go? You've got to have a trust to do that, or your assets will likely go through probate, which is not fun for your heirs. Believe me, I've worked with a lot of folks over the years, and that's not a good thing. Have you looked at your beneficiary form? So again, if you've got a divorce or someone has passed away, look at your beneficiary forms. Who do you want your assets to go to? Really important to look at that for your life insurance as well as your retirement accounts. If you have a 401k and you're working for a company, do you want all your assets in the market? Because that's all they offer you is really stocks, bonds, or mutual funds generally, which is all in the market. Perhaps you can do an in-service transfer, which means taking the money from the retirement account, transferring it into another retirement account that you can now manage, that you don't have to do everything in the stock market in. There's no taxes for you to do that. I have a lot of clients do that because they don't like the 15 choices or so of mutual funds that the 401k companies give them. So that's a possibility we can talk about if you're in that situation. And have you done a risk analysis of your assets? Or we call it RETHINK. It's on my website. I will refer to that a little bit later as well. But make sure that you know what your risk tolerance is for your particular portfolio. A 0 being, I want to put all my money in my mattress. I want to be as safe as I can. And 100 being, roulette wheel in Las Vegas. So we're all in the middle somewhere in there. So typically, if you have a 401k, for example, and you're all in the stock market, it's a 70 to 100 on that scale, on that risk scale. And if you fill out the RETHINK questionnaire, which is only about 12 questions, again, it's on my website, and we'll be happy to email it to you as well, you might come back as a 40. And if you're a 40, but your portfolio shows a 70 to 100, well, there's a disconnect here. We've got to fix that. We've got to get some money off of that table and put it into something that's more secure for you. So know what your risk tolerance is really important. Okay, I'm going to go into my slides here. So again, I am Kelley Slaught. I am the President CEO of California Wealth Advisors. Started doing this a very long time ago. I started in 1982 with Dean Witter, which I really date myself when I do that. They're now Morgan Stanley. So I came from the big wirehouses, they call them. So I know how they work, but working as an independent financial firm like I am now and have for quite a number of years is much better for my clients because we have a lot more diversification of product that we can put people into than the wirehouses, the Merrill Lynch's, the Morgan Stanley's, the Wells Fargo's, Ameritrade's, Schwab. We have a whole lot more that we can offer clients. And when I talk about strategies later, I'll go into a little bit of that. But that's why I'm an independent financial firm. We are a full service financial firm as well. So we do everything here, and I'll go over a lot of it here tonight with you. But love what I do, love helping clients. Like I said, I've been doing this a very long time. My firm is very committed to helping you. That's what our motto here is: how can we help our clients best? Everybody's different, so it makes the job interesting, that's for sure. We are all very passionate here about helping our clients. We love what we do. We'll be doing this for quite a number of years longer. We've been doing it for a number of years. So we love helping you, and that makes us a little different. I didn't realize that. A client told me that recently because I had a client ask me, or a new person ask me, what makes you different? Well, what makes me different is my master proprietary process, which I'll talk about later. But I had a client comment. She said, no, what makes you different is you're passionate and you love what you do. And it's very clear that you care about your clients. So I thought, well, that was a nice thing to say. So anyway, we are committed tonight to helping you learn some new information. We're going to introduce you to some, maybe some concepts you didn't know about before. We want to educate you on them, and we're going to illustrate for you how they might work and help you in your portfolio. Okay, there's really 3 different areas of investing. There's the accumulation stage, the preservation stage, and the income stage. So through your life, these are the 3 stages really we all go through for retirement, or for our lives, and then up to retirement. So the accumulation stage, you're in your 20s, 30s, 40s, 50s perhaps, and you're accumulating your assets. You're growing your business. You're buying real estate, you're putting money into your retirement accounts, whatever it is you're doing to accumulate your assets. That's the accumulation stage. Usually our risk tolerance in that stage is higher than it will be in the preservation or income stage. So the accumulation stage is where we've got more risk usually. We're accumulating our assets. Okay, then we turn probably 50s, 60s or so, we turn into the preservation stage. We now know we don't have 20, 30 years ahead of us that we want to keep working. And so we want to preserve the assets that we've built up so far. So preservation stage is important to then adjust some of your assets from the accumulation stage into that preservation stage where you've got some downside protection. Then you turn into the income stage, let's say 60s, 70s, 80s, 90s, there where you want to have income generated off of the assets that you've created for yourself over your life. So those three stages are very important. My job is, as a wealth advisor, is to really, picture a blank picture on the wall, a frame on the wall, and in front of that picture is a table, and it's got a lot of puzzle pieces on it. My job as a wealth advisor is to take those puzzle pieces and put them up on there and make the beautiful picture of retirement, of your asset planning that's specific to you. Because everybody's different, right? Everybody's going to have a different picture up there. So my job is to create those beautiful pictures for you and make sure it stays beautiful for you as well. So I am going to ask you at the end here to fill out the evaluation form. It's really important that you do that for us. We do these webinars. We've been doing them through this whole COVID situation. And we need feedback from you as to what worked for you or what didn't work for you. What information did I cover that was great, or what did I not cover that you really wanted to hear about? So I want to make these as best I can for you. I'm always willing to learn. So please fill these out for me. They're very, very helpful. Really appreciate it. Also, on this evaluation form, I am going to be suggesting some different things as we go along here tonight. So the Riskalyze questionnaire is one of them. Put that on your evaluation form if you'd like us to send that to you. I'll talk about a budget sheet later and a number of other things that you might want to put on here to request at the end of the whole program here tonight. So, I don't think this is a question on here, but you might put on here what scares you the most about investments or the markets, because I think that's an interesting question for me to ask these days. Okay, market volatility. Boy, have we seen that in 2020. Boy, we're all over the place. So let's cover that a little bit. We're going to go into key considerations for 2020. The impact of COVID-19 on the markets. Obviously, that certainly happened. The CARES Act, I'm going to cover a little bit about that, and tax considerations that we've had to deal with this year. Economic uncertainty, unemployment. Obviously, we can throw in the election in there. I'm not going to go political, that's for sure tonight, but it is affecting things that we're looking at. So, I will comment on that right now before I forget. So people ask me, especially with the election year that we've had here, what do I do about this, the election, this, that, and the other, who knows what's going to happen. I don't look at particularly who's in office at any one time when I do portfolios for folks. I'm looking 5, 10, 20, 30 years out. I'm creating a plan for people that is more, that has got more longevity to it. So over those 20, 30 years or so that we're planning for retirement, there's going to be lots of administrations that come and go. So I have my personal preference, absolutely. But I don't base my recommendations on necessarily who's in office. I look at the companies we're dealing with. I look at the economy in general, about how we're doing. And I have 2 webinars on my website actually with doctors of economy that you guys might want to look at if you want to have more up-to-date of what's going on today in the markets. So anyway, I look at, 5, 10, 20 years, 30 years out when I do portfolios. So it doesn't necessarily matter who's in office, although, that certainly affects all of us. We have had volatility in the market this year. We've been up, down, and sideways. So, these are the things that we need to prepare for, right? So we've had bear markets. We've had, we're in probably a little bit of a bull market right at the moment. But, it's interesting because I started in 1982. And in those days, we didn't have instantaneous news feeds. We didn't have, the volume of data that comes at us all day long. You watch the news at 6 o'clock at night. That was probably all you did in 1982. Today, we can look at our phones and get up to date on what's going on in Europe or Germany or, all over the world, what's going on. So today we have markets up 1,000, down 1,000 much more easily because we've got these instantaneous news feed and the market reacts to all of that. Not necessarily that it's a good thing or a bad thing, but know what you've got there. I mean, volatility really is the new norm. You know, the other thing that we also have today that we did not have in the 1980s when I started is we have computer programs that click off buy or sell orders if the market hits a certain amount. So you've got these computer generated programs that's making the market go up or down. So these are things that we have to look at as far as planning and how we're going to manage through that. So having downside protection is important. Having diversification is absolutely important. Inflation hedges, I'm going to go over that. And having a plan. You know, you got to have a plan. All right, what if you're retiring soon? Okay, I think this is really interesting, especially in light of what I just said there. We've got Dave and Ann here that are retiring at 2 different times. So Dave is retiring in a bull market, which means the market's going up. In 1998, that was the start of a bull market, or was within a bull market. He has $500,000 to invest. He's going to put it all in the stock market. He wants to take out $30,000 a year off of this account to fund part of his retirement. Anne, on the other hand, is going to retire 2 years later, which is the start of a bear market. That means the market's going down. She has $500,000 to invest just like Dave. Also, she's going to put it in the market, and she needs to take out $30,000 a year as well. Okay, what happens to these two? Well, look at this. So Dave is initially, he's in a bull market, so it goes up the first couple of years. His $500,000 turns into about, let's say, $675 or so, and he's taking out his $30,000 a year, and that's great in a bull market. That works. However, then we've got the start of a bear market here. So the market's going down. Well, their assets are going down for both Dave and Ann. They're both taking out $30,000 a year, but when you've got a diminishing returns portfolio like this, you're going to run out of money. So Ann ran out of money in about 2013. She doesn't have any money left. Dave is going to last a little bit longer because he did have that initial upturn in his portfolio, and that shows it here. He was up 26% the first year, 19% the second year, and then big downturns. So you can see here, they're going to run out of money. So you've got to make sure what you're withdrawing is not more than what you're making, especially if you want to keep that principal intact. So these are important things to be looking at. You know, we don't know. I mean, I do have a crystal ball behind me, but we don't know if we're in a bear market or a bull market at any one time. So we've got to plan for protecting your assets. So protecting your income against market volatility is very important. So let's talk about the Secure Act a little bit. What things changed with the change in the tax laws that we had? Well, one of them was, before I get into this, first of all, you do not have to take out a required minimum distribution for 2020. Trump passed that because of COVID, that we don't have to take those out. So if you have a required minimum distribution, which is the amount you have to take out once you turn 70 and a half, historically, it's usually about 4% a year that you have to take out of your retirement accounts. You don't have to take that out this year. Now, what changed is typically you had to take out required minimum distributions at the year after you turn age 70 and a half. Now it's changed to 72. So I was just talking to a client today. She's turning 70 this year, and she was a little worried about her RMDs. And I said, you don't have to worry about it until you're 72 now. So that's nice. You can also contribute to IRAs past the age of 70 and a half. You didn't actually used to be able to do that. So that was just a couple of nice things there that happened. Now, the previous non-spousal beneficiary, if you inherited an IRA, the previous law was that you could take out your required minimum distribution based on your life expectancy, which if you had a parent that passed away and you were 50 years old, your life expectancy based on your age 50, would be at least 25 years at least, that you'd be able to take out those funds now, or you could take it out over 5 years. Now they changed that. So now if you inherit a retirement account, then you have to withdraw all the funds within 10 years. So that's different. I mean, the government wants its hands on your money, right? And they want that tax money because it's a taxable event when you take money out of a retirement account. Now, these are non-spousal beneficiaries, by the way. So these are a parent passing away and leaving it to their children, for instance. If you are a spouse, this does not apply. You just inherit it, and now it's based on your life as far as when you have to take your RMDs and all of that. So anyways, wanted to be clear with that. Okay, Secure Act changes to 401k plans. 401ks now can be, part-time employees can participate in 401k plans if the company has that set up. You can have lifetime reporting and annuities as a strategy. I know I do annuities for 401ks as well. So that's a good way to get some protection for your portfolio. Okay, so different changes too might be that your assets might last longer. We've gotten more sophisticated tax planning for you for them. More income planning tools are available as well. So do a review of what you have. Again, what I talked about in the beginning, know where your assets are and know what they're worth. And then we can do some projections for you too. If you're going to retire in 5 or 10 years, we can look at, okay, what kind of income is going to be generated from my account. Okay, I do want to get into, well, before I get into all of these issues, I want to talk about Roth conversions because a lot of people ask me about those. So a Roth conversion, when you have a retirement account, an IRA, a 401k, a simple IRA, a SEP IRA, 457, 403b, there's all sorts of different ones. But if you have any of those, and you say, hey, I'm interested in a Roth conversion. Now, why would we do that? Well, a Roth conversion means a Roth is an account, retirement account, similar to IRAs, but the income, the dollars you take out of a Roth is tax-free, and the dollars that grow in a Roth are also tax-free. So there's different kind of rules and regulations about who can contribute and who can't as far as that goes, and I don't want to go into too much depth here tonight, but converting your money from a Roth that does away with that RMD requirement, because in Roth accounts, you do not have to take required minimum distributions when you're 72 now. You don't have to take it at all. If you want to leave those assets to your heirs, that's a tax-free benefit that your heirs will get. So everything that you have in a Roth IRA is a tax-free event. You have to own it for 5 years, but it's tax-free to grow and it's tax-free to withdraw money from. Okay, when you do a Roth conversion, because if you make over a certain dollar amount, I think it's $130,000 for single people and $190,000 if you're married. If you make over that, you cannot contribute new money to a Roth. So if you make over that and you want to put money into a Roth, what you can do is Roth conversion. So let's say you have $1 million in your 401k. And you don't really want to take money out of there when you're 72. Well, prior to 72, maybe you're 60, let's start to take money out of that IRA and put it into a Roth for you. Now, when you do that, you can do that, doesn't matter how much money you make, that is a taxable event of the amount you take out of the IRA and put it into the Roth. So if you took out $10,000, for instance, and put it into a Roth for yourself, that's $10,000 that's going to be added to your ordinary income tax rate, okay? So if you had $1 million in your 401k, we don't want to take $1 million out in 1 year and put it into your Roth because that's a huge taxable event you'd have there, right? But we like to feed money into there slowly, $10,000, $20,000 a year perhaps. I've had some clients do $100,000 a year. They have a low income year. They have a lot of write-offs they can use to offset that. So, usually the question I get is, when is a good time for me to do it? Well, a good time is a low income year. This is a great year to do it. A lot of people were on the sidelines as far as income goes. They had to close down their business. They had to stay at home and work, and so their income is less this year. So a low income year, or you had big write-offs for some reason, it's a good year to do it in either of those two instances. So I do have this. I know you can't see it, but when you do a Roth conversion, it's nice to know what your next highest tax bracket is and to try and keep yourself below that. So for instance, if you were in the 24% tax bracket and you made $150,000 a year, and you had $1 million 401k, let's say, and you wanted to take $50,000 out of there and put it into a Roth for yourself. Well, if you made $150,000 a year and you put 50,000 into a Roth, that would put you at 200,000. Well, that would throw you up into the next highest tax bracket, which would be 32% tax bracket. So let's maybe not do quite that much. Let's do maybe 10,000 we can do and not throw us into that next tax bracket. So those are the things that I work with clients about. We can talk about that later, but I wanted to kind of cover that because it is a question I get quite a bit from folks. Okay, income challenges for all retirees. I'm going to go into some of these in depth. Special challenges unique to women, a retirement income roadmap, planning for an income gap in your retirement. Really important questions to ask yourself. I'm going to discuss all of these. Okay, income challenges for all retirees. All right, funding burden on the individual. The next slide kind of shows companies don't offer 401ks so much anymore. They don't offer retirement plans a lot of times. Or if they have a retirement plan, they don't offer pensions anymore. They only offer the 401k, and you have to manage your own 401k. So it's definitely gone to the management of all of that to the individual investor or the individual person or couple to manage all of that, which is where I come in to help all of that, I suppose. All right, increasing healthcare costs. I'm going to go over that a little bit too. Those are only going up. The healthcare costs, #1 concern I get from folks, as well as long-term care needs. Inflation, I'm going to go over that a little bit more in depth, and some tax consequences of things as well. Okay, 59% of corporations used to have pensions. Having pensions these days, most corporations don't have them. They don't have pensions. They might have 401ks you can contribute to. And by the way, if you have a 401k that you work for a company and you are not signed up for the match that the company will do for you, absolutely sign up for the maximum max, because that's free money for you. When the company will match what you put in there, that's free money for you. So by all means do that. Today, only 16% of companies have retirement plans offered to their employees. So the burden really is shifting to the individual investor to take care of that. Okay, rising healthcare costs, $285,000. This is out-of-pocket expenses on healthcare after age 65. That's what the average is. Do you have that to pay for your healthcare? That includes any deductions and what your insurance might pay for. $285,000 is a lot of money to be paying for healthcare over age 85. This does not include long-term care. I'm going to talk about that a little bit later. But make sure you've got long-term care and healthcare costs covered in the plan that you do. Okay, really important to look at all of that. All right, 70% of all retirees will need long-term care. 3.7 is the years that women on average need long-term care or use long-term care. 2.2 years is the number of years that men typically need long-term care. So be aware of that. Be cognizant of long-term care needs that on average people are going to need and use. All right, let's talk about inflation. I always like to talk about inflation because, #1, diversification. #2, have a plan. #3, have inflation hedges in your portfolio. You need to have at least a 3% return on your investment, or it's growing by 3% a year, or the income streams are 3% a year to keep up with inflation. So if you have an average of 3% inflation, prices will double over a 24-year period. So the dollar today does not equal a dollar later or during your retirement years. So I like to throw a couple of these in. Let's see, how much did it cost to park at Disneyland in 1961? Specific year there, but how much did it cost to park in Disneyland? Poor Disneyland's not open yet, but anyway, it was 25 cents. 25 cents to park there. Today, I think it's around $20 to park there. A movie ticket in the 1950s was about 50 cents. 50 cents a ticket. Today, I think it's $9, $10, something right around there. One of the ones I like to talk about is the cost of college. The cost of a private college back in the 1960s, how much do you think that was? Cost of a private college back in the 1960s. It was about $475 a year. Yeah, wouldn't we love to pay that today? So I have my youngest daughter just graduated from college in London in May. And I didn't get to go see her graduate, unfortunately. They had everything closed down. But she got into USC her first year of college. She wants to be an actress. And so they said to her, you don't have to go to USC your first year. You can go to London, Paris, Italy, or Spain. And she speaks fluent French. So I said, go over to Paris for a year. How fun would that be for you? The film program doesn't start till her junior year. So she went over to Paris, and it was about half of what it would have been to send her to USC, which would have been about $75,000 to $90,000, somewhere right around there. So $475 in the 1960s for a private school, $75,000 to $100,000 today to send someone to a private school. So yes, she graduated over there. She went 2 years to Paris. She went 2 years to London. She decided not to go to USC. And I'm kind of glad, because it was much cheaper for me to send her over there, believe it or not. 4 years in Europe was cheaper to send her than to USC. So she just graduated magna cum laude. I'm very proud of her. And now she's in the master's program over there, getting her film master's. So anyway, dollar today does not equal a dollar tomorrow. Have inflation hedges as part of your portfolio. Really important to think about that. I do all of that when I project out 5, 10, 20, 30 years in portfolio analysis that I do. Okay, taxes. So taxes on pensions, taxes on Social Security. I'm going to cover that in a minute. Retirement account distributions are a taxable event. It's an ordinary income unless it's a Roth. I covered that earlier. It's a little different. There are taxes on interest, dividends, and rental property income as well. So know what your tax bracket is with all of this. Okay, special challenges are unique to women, and these are kind of some hard facts, and I am going to cover them. I don't really like to report them, but it is important for women to know the different challenges that we have. Okay, 50% of men, 50%, okay, let me redo that. 50% of men have more in savings than women. I think that's interesting. They have a bigger retirement account than women do. 50% of men have more than women. And why is that? They have more saved than women. And typically they have more saved because they worked all those years. They didn't stop working. Women typically stop working when they start to have children. So they stay home and take care of them. Maybe they work part-time, not full-time. Maybe they need to take care of their elderly parents or something. So they have less working years typically. 11% of women are more likely to participate in retirement plans than men, which I think is interesting. So men usually have about 50% more, but 11% of women participate more than men do in retirement plans. Okay, so according to actuaries, if you're a 65-year-old man, you have a 50% chance of living to age 87. You have a 25% chance of living to age 92. If you're a 65-year-old woman, you have a 50% chance of living to age 90 and a 25% chance of living to age 96. If you're married, you're going to live longer than that. So plan for the longevity that us women have. It's important to look at all of that. Okay, the likelihood of living alone. We are living longer. A lot of times we do end up living alone for longer than men do. So a couple of interesting statistics. Only 45% of women over age 65 live with a spouse compared to 70% of men. That's interesting. For women ages 75 and over, only 32% live with a spouse. So that's why we've got to plan for things. We've got to make sure that we know what we're doing here. I think this is interesting. Women, like I said earlier, are more interested in doing conservative investing. They are more careful with the assets that they have. And again, knowing what your risk tolerance is with this is interesting. And a lot of times I'll have couples do the risk tolerance questionnaire. The man does his, the woman does hers, and they're different. They're totally different with what they are. Sometimes women like more risk than men. You never know. So I like to ask because I want to know what your risk tolerance is to the portfolio that you currently are in or what we're trying to make for you. So it's important to know all of that. Okay, because of all these challenges, ages 75 to 79 are 3 times more likely to live in poverty. That's women, unfortunately. They don't have enough saved for retirement or they didn't plan for it. And unfortunately, 80% are more likely to be in poverty after age 65. So, you've got to prepare. You've got to have a plan. Let's make sure this doesn't happen for any of us here. Okay, retirement income, so savings and budgets. Let's talk about those for a minute. Before I get into that, I want to talk about budgets. I want to absolutely make sure everybody knows what their budget is. Where do you save? How much do you save? How much do you have saved? What is the income that you need per month to have generated from your income? So I'm going to take my screen bigger here, and I'm going to show my budget gap. So what is your budget gap? What is your budget? And I have a questionnaire that I hand out to folks. And again, you can put this on your evaluation sheet that asks you, what income do you have, Social Security, rental properties, what are your expenses, utilities, mortgage, any of those kind of questions. You need to know what those are, and everybody's different with that. So know what your budget is, because for instance, in this situation here, here's your house, here's your family. Your goal in retirement is to create $10,000 a month off of your different investments and what you have. Okay, how are we going to do that? Well, in this situation, we've got a pension that's going to pay us $1,000 a month. We've got Social Security. We're a married couple, and we're going to get $4,000 a month. So we're going to generate $5,000 a month just on our pension and our Social Security. Well, you just told me you need $10,000. So we have a gap here, don't we? We've got to figure out this $5,000. Where are we going to get it? Well, we're going to go to your 401k. We're going to go to your IRA. We're going to generate income from these for you. Maybe you're going to work part-time. Maybe you're going to have some rental properties. Maybe you have other investments that generate income for you. So where are we going to get this $5,000? This is where we're going to go to create the $10,000 that you're looking for. So again, you've got to know your budget. You've got to know what your goal is, right? If you like to travel or you like to go out to dinner all the time, put that in your budget. We can budget for it. If you tell me what your budget is, a lot of times I can help you get there. But I need to know what the budget is first. By all means, ask for the budget questionnaire. This is what it looks like here. But a lot of questions on here. But it's good to know that. Absolutely good to know that for you and your portfolio and how I can help you get there. Okay, let me go back to my slides. Oops. Okay. All right. So if your budget is $10,000 and we can only generate $8,000 for you, well, we've got a disconnect there, don't we? So how are we going to do that? How are we going to manage into retirement that way? Well, we might have to make some tough choices here, or we might have to do some planning. Maybe we have to reduce our spending. Maybe there's different things we can change to not spend quite so much. Maybe we don't go out to dinner every single night. Maybe we only take one trip a year, not 2 or 3. We need to re-examine your discretionary spending. So again, out to dinner or whatever fun things you like to do, maybe we need to look at that, or maybe we need to shift that slightly. Maybe we need to downsize. I have a lot of clients that they're married, their spouse passes away, their kids are moved out, they've got this big 5,000 square foot house. They really don't need that just for themselves. So how are they going to, take care of some of the spending or income needs that they have? Well, maybe it's time to sell the 5,000 square foot house and buy something smaller that you can manage that will cost you less. So downsizing is not a bad thing at all. It can be a really good thing because, I've had 5,000 square feet house too. All my kids are gone, so I don't need that kind of space anymore. So consider downsizing. That might not be a bad thing. Review your debt. Obviously, we don't like debt, especially credit card debt. So if we have any kind of debt, we need to definitely pay that off. That's not ever a good thing to have. So let's make sure we look at the debt we have and make sure it's good debt. Good debt is mortgage debt because you can at least write off some of the principal or the interest expense from that. All debt's not bad, but let's make sure we have good debt for you. Okay, again, how are you going to create income for yourself, your pension, your Social Security, your retirement savings, distributions, any kind of other assets you might have? We're going to look at all of this and do a plan for you. So again, having a plan is really important to figure all this stuff out. Okay, let me talk about Social Security here. So Social Security, the first age you can take Social Security is at age 62. Now, if you need the money at 62, perhaps your spouse has passed away or you have physical challenges, take it at 62. You need to go to socialsecurity.gov. By all means, go in there and sign in. It's really easy. You put a username and password. It brings up all of your years of work that you've had and what Social Security will pay you at age 62, age 63, age 64, age 66, age 70. Every year that you wait after age 62, you get 8% more per year. So 66 is considered what they say full retirement age. So to take it before that, you're going to get less. And oh, by the way, that less amount you're getting is going to be fixed. It's going to have a cost of living increases, but it's going to be fixed at 8% less per year for each one of these years that you choose. So 62 is the lowest amount you will get. I don't recommend people take it at 62. You're going to get more each year that you wait. 66 is really full retirement age where you get most of the benefits in there. So go to socialsecurity.gov. It's a really good place to go to figure out when to best take it for you. Okay, Social Security benefits are based on your lifetime earnings. The formula is a little complicated, but it averages the income from your 35 highest earning years. They take the last 30 credits, they call them, but they take the last 40 credits, but they look at the last 35 highest earning years. So a question I get a lot is, can I get Social Security if I work? And the answer is yes, you can receive Social Security benefits while you're still working. If you've reached full retirement age, you can work and earn. You can work and earn as much as you want and get your full Social Security benefits. If you're under the full retirement age 66 for most of us, but receiving Social Security, your benefits will be reduced temporarily until you reach full retirement age. So just know where you're at on that spectrum. The other thing I want to talk about is taxes here. So a lot of people don't realize that taxation of Social Security is absolutely something we have to contend with. They don't realize their Social Security benefits can be taxed. So the numbers that we have here is if you're married filing jointly and you earn under $32,000 a year, then zero of your Social Security will be taxed. However, if you make over $44,000 a year, up to 85% of your Social Security can be taxed. So a lot of people don't realize that. If you're single and you make under $25,000 a year, zero will be taxed. If you make over $34,000 a year, up to 85% of your Social Security can be taxed. So just be aware of these things. Okay, overcoming the income gap. All right, let's talk about that. All right, how are we going to do that? If we don't have quite enough money yet to retire, how are we going to fix that? Okay, one way is to do catch-up contributions into your retirement plans. If you have a 401k, you can put in up to $26,000 a year, $19,500 if you're under age 50. You can add another $6,500 if you're over age 50 to make it $26,000 a year. You can put in there. If you make, let's say, $20,000 a year, then you can only put $20,000 a year in your 401k. You can't put 26. If you don't have a 401k, but you want to do an IRA or a Roth, if you're over age 50, you can do $7,000 a year. Now, the $7,000 a year in your IRA, you can write off your taxes, because then once you put that in there and it grows for a number of years, you retire, you start taking money out, it's a taxable event to you at that point. For a Roth IRA, you can put $7,000 a year if you're over age 50. If you make under those amounts I mentioned earlier, I believe it's $130,000 for single people and $190,000 for married people. Again, Roths are great. It's tax-free when you put it's going to grow for you tax-free, and then when you take it out, it's tax-free as well, and you don't have to start taking money out when you're 72. But there are some rules and regulations there that we have, so just make sure what those are. But those are ways for us to increase our wealth, so we can build wealth, so we can get to retirement and have the assets we need to generate the budget that you're looking for. Okay, rethinking your retirement. Okay, move at your own pace. There's no rush for any of this. We don't want to take forever, certainly, but we do want to make some decisions, but do it when it's comfortable for you. We're all different with that as well. Maybe funding your HSA. I've started working with folks with HSA, health savings accounts. So if you haven't established one of those and you qualify for one, it has to do with your healthcare policy that you have as to whether or not you qualify for an HSA account. But that's money you put aside and you use it for any kind of health issues that you might have. You put the money in there, it grows for you tax-free, you take it out, it's tax-free as well. So it's a nice account to have. Like I say, I'm just starting to work with folks with that. And consider long-term care health insurance. Okay, I'm going to cover that in a little bit, but absolutely have long-term care for yourself. It's important to have that for your peace of mind as well as for your families. Okay, I'm going to go into here what makes me a little bit different as far as financial advisors go. So I created this wealth assessment, this California Wealth Advisors mass proprietary process a number of years ago. So this is the world of investing here. So the M is the managed money stock market, A is alternatives, S at the bottom there is safe money. So the M in the stock market. So typically when people bring me 401k accounts, they just retired, they have this $1 million in their 401k, and they're leaving the company, so they want to put it into another retirement account. They roll it over, it's called a 401k rollover. And they now are into an individual retirement account. Again, no taxes for any of that. But usually what I see with 401ks, it's all right here in the light blue section. They don't give you any other choices. It's all stocks, bonds, or mutual funds. And usually people don't necessarily want to have all of their assets there, especially if you have $1 million or something. That's a lot of money to have in the stock market. So they want to diversify. So how do we do that? Well, the A section is alternatives. So these are investments that don't go up and down with the stock market like the light blue section does. They keep their value fairly steady. They pay income streams. So I go here for bond replacement values. I started the business, like I said, in the 1980s, and we did a lot of tax-free bonds in those days, 9% state and federal tax-free bonds for 20 years. We would love to have those today. No such thing today. But where do we go for bond? Because interest rates are so low. So I don't put people in bond portfolios because, gosh, the 10-year U.S. Treasury is less than 1%. So don't tie up your money for less than 10%. So we go here to these alternatives, and most of these are real estate programs that are not traded, because traded ones would be in the light blue section, right? They're going to go up and down in the market. These are ones that are not traded. That's a good thing. They're not going up and down in the market. It also can be a challenge because they're not liquid. We can't liquid. It's like buying the building I'm in here. We can't liquidate it tomorrow and get your money out. So they're about 5 years in length, most of them. They usually pay about 4 or 5%, 4, 5, 6%, some pay 7% in this alternative space. And monthly income that comes in for you, that's great for your budget. So when you want a monthly income when you retire, this is a great place to put some money. They also have growth involved with these as well. So typically, if you're buying commercial real estate in this alternative section, you're getting some income off of it. You've got some growth over those 5 years as well. So nice place to put some of your assets, but not liquid and not guaranteed either. So I never, I look at track records when I look at these. Obviously, I look at the 20, 30-year track records of the programs in this alternative space that I recommend for people to make sure I'm doing the best I can to bring you. And I travel the country normally to go meet the CEOs that run these companies because I want to know what their track record is. I want to know, did they do well in down real estate markets as well as up real estate markets? And if the answer is no to any of those, then I don't use them. So I'm very particular about what I do. So this is real estate programs over here. Also loan programs, again, bond replacement values. The loan programs don't have a growth to them, but they have nice income streams, 5, 6, 7%. I have one right now that one of my CEOs brought me that's 9% for 36 months. So it's a great deal. It doesn't come around very often, but I get those because I have these established relationships with the CEOs I work with, and they bring me these special deals every now and then. So anyway, the alternative space is great for income, some growth, and bond replacement values as well, and investments that are not involved in the stock market, not going up and down like that. Down here at the bottom is the safe money. So this is annuities, this is life insurance, this is long-term care, any kind of an insured type of product. So I like doing this mass proprietary process here for folks because it diversifies portfolio. And what's the thing I told you earlier? Diversification is number one for me. Because if the market's going up in this light blue section and you have money there, great, we're going to participate in that. It's liquid, that's great too. If we want to sell anything out of there tomorrow, we can. But it also has volatility to it, doesn't it? It's going to go down in value as well as up in value. So, so having some money there is fine for liquidity purposes. And then obviously your risk tolerance, we need to know what your risk tolerance is when we put money over there. The alternative space and the safe space, those are probably going to hold their values just fine if we have a down market. So if the light blue section in the stock market is going down, we've got the dark blue section and the gray section that's probably holding our portfolio steady. What does that do? That makes it so you can sleep at night. You don't have to worry about your portfolio. I have many clients come to me because they're 100% in the stock market. Stocks, bonds, and mutual funds are all in the stock market. They all trade. And they're worried. They have a hard time sleeping, and it breaks my heart because I don't want to see that. I want to have diversified portfolios so you can go to sleep at night, put your feet on the floor in the morning, and know that your portfolio is fine. Know that your income's coming in for that budget you gave me that we got for you. So so know what your risk tolerance is. That tells us different things here with where to put some of the assets. This shows, 33% of 100% of a portfolio, but it's different for everyone. Some people don't want to be in the stock market at all. Some people have real estate in other areas and they don't want any more in that section, but they want to have some downside protection. So that's what this bottom safe money section is for. So I'm going to make my screen bigger here and go over that gray section. So what did I say? Annuities, life insurance, long-term care. I'm going to cover that right now. So this is something that I've never seen an advisor but me do this for people. So I want you to understand what is offered in this section. So here's annuities. I'm going to go back to my little board here. So annuities. So I'm going to explain what annuities are because most advisors never explain what they are. I think most advisors, frankly, don't know the difference or they don't know how to explain the difference, perhaps. So I'm going to take the time to do it because I think this will be very educational for you all. Okay, there's three different kinds of annuities: a fixed annuity, a fixed indexed annuity, and a variable annuity. Okay, a fixed annuity is like a bond. You put money in, let's say it's $1,000 for 10 years, you get 4% a year, you get your money back after 10 years, you're done. That's a fixed annuity. On the other end of the spectrum is a variable annuity. So what do? Here? They buy mutual funds. So sometimes I see these in 401ks, but remember, this is in the market, right? It's a mutual fund, so it's going to go up and down with the market. I never really know what you're going to take out of here. There might be some guarantees along the road for that, but not your principal. Your principal is going to go up and down over time. In the middle is a fixed indexed annuity, which in my view, takes the best of both worlds. You've got the upside potential of the variable annuity in the market. You've got the downside protection of the fixed. So that's what a fixed indexed annuity is. This is what the chart is for a fixed indexed annuity. So for instance, you put in $100,000 into a fixed indexed annuity, and let's say the market goes down. Well, your 100,000 is going to stay at 100,000. It's not going to go down with the market, which it would with a variable, right? It's going to go down with the market. So your 100,000 is going to stay at 100,000. And then let's say the market starts to go up. Well, you're going to participate in that. Your 100,000, let's say, turns into 120,000, 140,000, and then the market goes down again. Oh, guess what? Your 140 is going to stay at 140. You're not going to go back to 100 or 120 even. It's going to be locked in at 140. I like that, right? We've got the downside protection. We don't have that when we have other investments in the stock market. So typically, you're going to have some years where you have a 0% return because you didn't make any money, but you didn't lose any money either. Some years you're going to have maybe 9% or more. Typically, it's somewhere between 0 and 9%. Or I usually tell folks if I look over the last 30 years, you're going to have somewhere between 4 and 9% on average return for these. I like these because they have the downside protection. They have a pretty nice return here. What you can also do is turn on income streams for these. So when you give me a budget and you're going to retire in the next 5 or 10 years or so, we can turn on these income streams for this annuity, which, oh, by the way, will be guaranteed for your life and increasing. What did I say about inflation hedges? We need to have inflation hedges built into our portfolio, usually about 2-3% a year. So if you put in 100,000 and it grew to a whole bunch of money and you started taking money out, and let's say the first year you took out $10,000, the next year would be $10,500, the year after that would be $11,000, 11,000. So it's increasing and it's guaranteed for your life. So if you live to age 95, 100, 105, it doesn't matter. You're going to have that income streams coming in for you. I don't have another investment that will do that. Obviously, if you put money, like I showed with Dave and Ann earlier, if you put money in and you're taking out more than it's earning, you're going to run out of money at some point. This does not work that way. And I can do illustrations for you that will show all of this for you. Now, I want to talk about life insurance as well here, because the life insurance programs that we have, they're indexed life insurance. So they work the same way as this chart here. You're going to participate in the upsides of the market, not the downsides. You're going to get long-term care attached to them. A lot of times if we have older programs or older life insurance policies, more than 5 years old or so, we take those, we do a 1035 exchange into a new one. I add long-term care for you, I increase the death benefit, and we can create income streams for you from these policies as well. Works a little bit different than the annuities, but we can do it. So and that's tax-free, by the way. You take money out of this account and it's a tax-free income stream for you. So life insurance with long-term care, it's going to give your heirs a death benefit that's tax-free. It's going to give you income that's tax-free if you decide to take it. So if you have any policies that are 5 years or older, bring them to me. We'll do an evaluation for you and look and see if we can add some of these things for you. So this is how I get long-term care for folks these days. To buy a straight long-term care policy is very, very expensive. It's $30,000, $40,000 a year. And if you died the next day, that money's gone. I'd rather have you have something that actually has cash value to it. If you ever needed the money, you could take it out of there. So here's annuities and life insurance for you. Again, I think most advisors don't know how to explain all of that, so I wanted to take the time to do it. So hopefully you learned something new there. All right, let's go back to the slides. Okay, all right, so I talked about fixed indexed annuities. You can take immediate income from these types of policies, either the life insurance and or the annuities. You can take immediately if you had $1 million in your 401k and you wanted to put $500,000 into an immediate annuity because now you're retiring today. You can do that. You can absolutely do that. You can have deferred ones as well. You can put the money in there and let it grow for a while before you start taking out. It's my preference to do that. Let it grow a little bit because the engine's better for you. It gives you more income over time. Okay, you can also do a single life for annuity withdrawals, your life. You can do joint with your spouse's, or you can do it for a period certain, which means I want certainly, for 10 years for sure kind of thing. So there's different choices we can take with all of those. Okay, as I indicated there with Dave and Ann, pick a conservative withdrawal rate. Make sure that your withdrawal rate is not going to make your funds go to zero at some point like I did with Ann earlier. If maybe Ann should have taken out $10,000 instead of $30,000. Again, where are we going to get the other income for her that she needed? Well, we're going to go to the other assets, or we're going to start contributing now so she'll get that income for herself. So just pick a conservative withdrawal rate when you do that. And again, I sit down and work with people all the time with these. All right, life insurance absolutely has cash value to it, and you can take out the tax-free withdrawals from it. So it's a really smart way of investing, taking care of your heirs and any long-term care income needs that you have. Okay, before I leave insurance, I thought this was an interesting quote. The English astronomer Edmund Halley prepared the first detailed mortality table in 1693. Life and death could now be studied statistically, and the life insurance industry was born. So 1693, so annuities and life insurance have been around quite a long time. And many of the companies I work with actually are 100, 200 years old. Okay, what can you do to prepare for retirement? All right, create an income plan. As I told you, have a plan, diversification, inflation hedges, that's the number 1, 2, 3 things for me is creating a plan. Perhaps you're going to increase your 401k distributions. If you don't have a 401k, what I do with a lot of clients is we set up automatic contributions to go to their regular accounts with me, or if they have a trust account, we do that. So that's how you build wealth as well. If you don't have retirement plans, you're doing that with, you can do it in regular accounts as well. Doing, even $50 a month, $100 a month, $1,000 a month is really how you build wealth. So it doesn't have to be a retirement plan. It can be a regular account as well. Contributing to your traditional or Roth IRA account is also how you build wealth, and looking at health savings plans is also important. Okay. Before I go into that, I want to, I'll make my camera bigger here. Okay, so I do have, if you're just about to turn 65, you're going to get inundated with information about Medicare. So I do have a specialist here that I work with in town that looks at Medicare for you. It's free. His company is fantastic. They help people if they have a claim they want to file that is having an issue of some kind. You just give it to his company and they research it and get it all straightened out for you. So it's a great company to have. So It's free, like I say. You're going to pay if you go to any of these other services. There's all sorts of different services out there, but they all charge you a little bit of something. But who I work with here is free, so I'm happy to give you his information. Again, put it on your evaluation sheet if you're interested in looking at your Medicare, because it's brain damage to go in there and try and figure it out. That's for sure. There's so many choices. Also, I have some attorneys that I work with that set up trust accounts for people. I love referring people to them because we all need a trust. You need to protect your assets from probate. You need to protect your assets for your heirs. If you have children, you don't want them fighting about your assets if you pass on. So have a trust that is very clear about the designation of that. I also help people with homeowners and life insurance homeowners and auto insurance that they have. We can a lot of times lower the amount that you're paying. These are all A+ rated companies. What you do is you give us your declaration pages. We give it to the company. They go shopping around to 50 different companies. They give you back the best A+ rated company they can find. And typically they can save you a lot of money on your homeowners insurance or your auto insurance. So they saved me about $300 a year, which was great. I love doing that. Okay. Some of the main key takeaways I want you to take away here from us today is diversification is absolutely key. You heard me say that this whole time. Inflation hedges, have that built into your portfolio, or do you have it built into your portfolio? You need to know that. And you need to create income streams that will last for your life. There's not many products out there that will do it, but we do have some that will help you get there. Have long-term care, have life insurance. If you haven't looked at your life insurance, let us look at that for you. Maybe we can add long-term care to that. Really important to do that. The younger you are in doing that, the better, the cheaper it's going to be, the better in health you are. You don't know in 5 or 10 years what your health is going to be. So if you do it now, it's a much better return you're going to get. Have you looked at your legacy planning? Do you have a trust account? Let's make sure that you have that set up for yourself. If you have a trust that's more than a couple of years old, you need to review it. You need to look at it and get an update for you. So I can give you trust attorneys' names for that. We can help with auto and homeowners insurance if you want us to look at that, as well as Medicare that you have. Have a plan. Absolutely have a plan for yourself. You need to do that. Have a wealth creation assessment done for yourself. Turn in your evaluation forms for me. I really appreciate that. If you're interested in the budget sheet that I mentioned, if you're interested in the Riskalyze or any of the other things I mentioned today, by all means, let us know, and we're happy to send that to you. We'll be sending you the evaluation sheet. Please fill that out for us. It's really important for us to be better at what we do. Okay, this is what happens when you don't have a plan. So let's not have this happen to any of you. We want to make sure we have a plan and not be caught unaware of something that might come our way in the future. So I want to thank you all for being here. It was a pleasure for us to help teach you something tonight. Hopefully you learned something good and new and interesting, and we gave you some things to think about. So with that, I'm going to sign off and have a great evening. By all means, get in touch if we can help you in any way.